Welcome to Everyday Economics, the podcast that helps you learn about the economic world happening around you every day. I'm your host, Chris Krug, president of the 501c3 nonprofit, nonpartisan Franklin News Foundation. Everyday Economics is a production of America's Talking Network. You can check out all of our great podcasts at americastalking.com. To support Everyday Economics, please make your tax-deductible charitable contribution by clicking the link in the show description. We are recording this episode on Thursday, October 19th, and joining me as always, my friend and colleague, Dr. Orphe Divounguy, PhD economist. Dr. O, Consumer Price Index came in about a week ago, and in looking at the trend line as a graph, it kind of looks like sort of like a sliding board, except the bottom of the board is starting to point up a little bit and it is stuck somewhat after reaching, a number of, I believe it was like 2.5% 3 months ago. It's ticked up, and it's hanging out closer to 4%. The last 2 months have been almost identical. And we're talking, of course, those are year-over-year differences. So what sense do you make of the most recent CPI report? What do you see in there that would be of value to understanding sort of where we go from here and whether or not the Fed needs to get more involved?
Inflation in services remains stubbornly high. It's coming down, but it remains pretty high. And ultimately, housing is a big part of that story. But there isn't much the Fed can do about that. There just isn't. I mean, housing is kind of like food, okay? Everybody needs it. It's not like, hey, today I'm going to sleep on the streets and tomorrow I'm going to be in a home. Everybody needs housing. And so demographic factors, millennials aging into home buying, are why we need more housing in this country. Right? Housing has been underbuilt for more than 15 years. Builder productivity lags the rest of the economy. Productivity growth lags the rest of the economy. And so what can the Fed do about that? This is one of those things where government at all levels needs to act, right? So this is the problem. The good news is builders have been super active. Building completions are at higher today than they were at the highest level in, 15 years or so. Builders have been really active in the multifamily sector, and apartment rent growth has slowed tremendously. Good news. But, single family, even in the single family sector, we've seen a lot of building, but we're still so much behind. And builders are probably not going to be able to close that gap. And so that's causing pressure on prices and rents. And that's showing up in the CPI and PCE. And so that's what's going on with inflation. Now, retail sales higher than expected.
Did that surprise you? Can I just ask you that? Just straight up. Did that surprise you that retail sales continue to grow year over year?
It would have surprised me had I not seen the Bureau of Economic Analysis revisions that show that basically when most people were talking about excess savings down to, $500 billion, excess savings excess household savings still exceed the $1 trillion mark. And so when you see that, you realize, well, that makes sense, right? Savings is essentially wealth. People are wealthier today than they were before the pandemic, both in the actual savings, the net worth, their housing wealth, their stock market wealth. Americans are simply richer than they were before the pandemic. And that's it. And so as long as you have all those extra savings and you got this massive, you had this massive increase in wealth, and that hasn't come down. In fact, that's improved as inflation came down. Real wealth, real incomes have also increased. And so then it makes sense. It makes sense that people are still spending, right? And so that's also part of the story, right? So should the Fed hike? Probably not. Here's why, right? Because I think everything I said so far points to higher inflation. The bond market has reacted to the news, right? So you saw yields increasing, longer term yields finally increasing. Increasing at a rapid pace.
That was really interesting. Just looking at that at the graphic where was almost no marginal difference between a 2, 5, 10 and longer term bond yield. They're kind of coming into they're almost like squaring up. So whether or not you park your money in a bond for 2 years, 5 years, 10 years, that the rate of return is almost exactly the same right now.
Yeah. So you have to understand, the Fed was raising short-term rates by raising its key policy rate, right? So short-term rates responded really quickly. But the yield curve was inverted because basically long-term rates were falling. And were falling behind short-term rates. And ultimately, those long-term rates had to go up. And now the increase in long-term rates is very similar to, if not more powerful, in fact, to the Fed raising interest rates again. So that reaction, I think, is from investors, from traders, is going to be why I think a slowdown is coming. A sufficiently high enough slowdown that you are not going to continue to see inflation tick higher, right? We're going to see activity continue to cool down, right? And I guess to some extent you could argue this is the lagged impact of monetary policy at play. You're going to see inflation continue to cool down. You're going to see hiring continue to moderate, right? Because ultimately, the consumer is going to have to pull back due to higher interest rates. Higher interest rates that do what? Higher interest rate incentivize you to save more and basically keep you from borrowing more, right? Borrowing and spending more. And so those factors are going to cool down the consumer. Businesses are not going to be able to borrow to expand as much because rates are higher. We're already seeing that. It's just going to accelerate even more, right? And so all of those factors are going to bring down labor demand, bring down wage growth, and we're going to see inflation continue to moderate. So the Fed doesn't necessarily have to do a lot more from here. In fact, if the Fed does too much, it could push the U.S. economy in a recession. And so I expect the Fed maybe to continue to wait it out and see what happens. Although the market is now expecting Fed hikes at the start of 2024 because activity has been so strong. But I don't think the uptick in activity is going to persist given how rapid the increase in yields has been. And the last point, a rapid and disorderly increase in yields is risky. If it was slow and steady, that's one thing. But the rapid increase, the quick increase that we saw just in the last month or so is risky for a lot of sectors that are interest rate sensitive. And so I think the risk of a recession increases if we continue to see yields surge as fast as they have in the past few weeks.
Appreciate the thoughts as always for Orphe Divounguy. This has been Chris Krug. Subscribe to Everyday Economics and dozens of other quality podcasts at americastalking.com.